Welcome to the Yorkshire Shadow MPC, a partnership between Clive Owen LLP and the York Press. After some light relief celebrating the Queen's Platinum Jubilee, sadly it's back down to earth with a bump. Inflation stands at 7.8%. I am actually old enough to remember when inflation was a lot higher than that, but for most of this generation, they've never seen anything like it. And the cost of fuel continues to rise, and that's really causing concerns for consumers and businesses. And just this morning, GDP was announced as falling by 0.3%, with manufacturing and construction both contracting. There was a chink of light in those figures, and that was the output in consumer-facing services. They rose by 2.6%, and that reflects the growth in spending on hairdressing and food sectors. Now I'm going to ask our Yorkshire MPC members if their real-world experience reflects these downbeat figures. And I think I'm going first over to Dave Broadbent from Begbie's Trainer. Dave, you work in insolvency. Looking at these figures and everything we're seeing when we watch the news, it would seem that you're going to be one of the busiest people on the panel. But actually, is that what's happening? I think Dave's frozen, so we'll come back to him in a second. Gary, financial advice, high worth clients, businesses, what's it really like out there?
Well, it remains choppy. I think that's a fair assessment. Markets don't like uncertainty. They perform well when there's certainty in where they're going, and unfortunately, inflation is creating an issue. So yeah, we have inflationary issues as well as the ongoing situation that's occurring in Ukraine, which is leading to rising fuel prices, rising costs of wheat, etc., and food, which is reflecting in inflation both in the UK, Europe, and around the world. As you mentioned, the CPI figure was around about just over 7%. It is forecast to exceed 10% when the next Monetary Policy Committee meeting is held later this week. In terms of inflation, America, there was signs that the hump or the rising inflation had reached its hump in America, but unfortunately, America exceeded market expectations last week when they announced their CPI figure at 8.6%, and markets were expecting 8.3%. Most markets now anticipate when the Fed meet later this week, they will increase interest rates by a further 50 basis points as they seek to bring inflation back to their 2% target, whilst not trying to put too much pressure on the recovery in GDP growth within the United States. Within the UK, unfortunately, expectations about interest rate rises continue. When we had this meeting earlier in the year, the expectation was there would be between 1 and 3 interest rate rises by the Bank of England during 2022. Unfortunately, the market now anticipates there will be a rate rise every month for the rest of this year, with the Bank of England base rate ending the year somewhere between 2 and 3% based upon current figures. But this is a very rapidly moving market and area, and interest rates could rise beyond that. So we continue to monitor that. But unfortunately, it is choppy times. Until inflation gets under control, there will be pressure on central banks to raise interest rates. The one good thing is global GDP, even after inflationary rises and rising interest rates, is still forecast by the IMF to come in at 3.6% this year, which is still above the long-term global GDP growth figures. So there are some good recovery signs there. And also, if you look at companies that have reported earlier this year, 80% of the US companies that reported declared profits that exceeded market expectations. So it's not all doom and gloom, but it's going to be a while before we see the green shoots of recovery.
So you think it's more likely to be the recovery R word than the recession R word?
That's depending upon how much the central banks are forced to put up interest rates. It's a tight balance. But we still think with a 50 basis points increase in the US and there being close to potentially the peak of the rises, recession might be avoided in the US. But things are moving that fluidly that this could change in a week, a month's time. At the minute, we don't expect a recession, but that could happen depending if rate rises have to keep being increased to try and contain inflation. Slightly different in the UK because the US is less reliant on imported fuel. The UK, we do buy fuel in dollars, so there is more of a potential for a technical recession in the UK than potentially a deep recession in early 2023. But we continue to monitor the rise in inflation and interest rates and the impact it's having on the UK economy, because there's still plenty of slack in the employment market. There are plenty of job vacancies out there. We're not seeing wage rises keeping pace with the inflationary rises that we're seeing. So we can't discount there won't be a recession at some point, but that might be a technical recession rather than a deep recession that we saw in the 70s and 80s.
Oh, thanks for that, Gary. I'm going over to Dave Broadbent. Dave, you're in insolvency at Begbie's Trainer. You must be incredibly busy at the moment, or is actually that not translating into your work?
Yeah, good morning, everyone. It's yes and no is the answer, being honest with you, because it was quite interesting hearing what Gary was saying there, because I suppose we have two different types of insolvencies that are happening at this moment in time. We've got a low number of what I would call traditional insolvencies, which are businesses that have just ground to a halt for whatever reason, either unable to pay the creditors or a drop in turnover. But we are still seeing high levels of very small businesses, what we call PSCs, personal service companies. So these are individuals within the package of a limited company, still failing, mainly as a result of the inability to make repayments on the bounce back loans. Everybody will remember that these were handed out 2 years ago, and we're now 2 years on, and we're hitting the point at which people are being asked to repay back, in some instances, quite large amounts, 40, 50,000 pounds, which in isolation isn't a lot. But when you look at the statistics that they're expecting to come through, it's about 1.5 million bounce back loans were given, and they're anticipating somewhere in the region of 30 to 40% aren't going to be able to be repaid. So what that's going to do is create a very large hole in the economy. A lot of these people that we're speaking to are simply failing as a result of them not bouncing back, to coin the phrase. They're just not hitting the turnover levels that they were enjoying before the pandemic took place and the resultant lockdowns as well. So it's a difficult one to call. One thing that I would say, and I know it's something that I've mentioned in the last few of these that we've done, is we still yet haven't seen the sleeping giant, which is the Revenue and Customs, starting to collect their money in. There are millions and billions of pounds still owing in unpaid tax, not only for the period prior to the pandemic, but also that's accrued in the last couple of years. The Revenue and Customs, although they are using quite a few officers to field officers, as they're known, to actually attend premises, we aren't seeing the amount of collection work that they have historically done being undertaken. And in certainly the last two recessions that I've worked through, one of the biggest drivers has been the collection procedures undertaken by the Revenue and Customs. So I think, picking up on what Gary just said then, a lot of it will also depend upon whether or not the Revenue and Customs are lenient with their customers, i.e. the general businesses in the UK, or whether they take a more firmer line. Just one last one as well. We are now starting to see the Revenue and Customs starting to do sector reviews of furlough payments and other benefits that were provided to companies to assist in the last couple of years. So again, that itself is also, is also going to generate an amount of recovery action taken against businesses.
So actually there could be choppy waters ahead for quite a lot of businesses. And it sounds from what you've said that the bounce back loans, while they did help a lot of businesses, they are actually, for some, they've only delayed the inevitable, and now they're hitting trouble and going out of business.
Absolutely, yeah. They have brought in, the government were very quick to react, and they brought out what's known as a pay-as-you-grow scheme, which is effectively where you can elongate the payments needed on a bounce-back loan. So it extends the duration from the original 6 years that they provided up to about 10. The problem is people are taking advantage of, one, the ability to not make payments. So basically, bounce back loans were undertaken in early or in sort of spring 2020, summer 2020. So you didn't have to make any repayments for a year. You could then firstly take advantage of a 6-month holiday payment. So that gave them another 6 months. And then in addition to that, under the pay-as-you-grow, you could also apply for 3 stints of interest-only payments. So what people are doing is they've tacked on that final 6 months. They've managed to do that first batch of interest-only payments, but they're having a look at it and thinking, this is continuing to accrue interest. I'm a small business. It's going to take me 7, 8, 9 years to try and get myself out of this position. It's just not sustainable. You know, some people are late 40s, early 50s. They've got one eye on retirement. And from their perspective, their own view is, well, I only took this really out because I was told to cease trading. It's not proper borrowing that I've undertaken. So yeah, we are still seeing high levels of small companies entering liquidation. Whether that has a massive impact on the economy, I'm not too sure. I think the biggest one is going to be whether or not the revenue customs decide to start sharpening the tools.
Oh, thanks for that, Dave. Not particularly optimistic, but we can but hope. Steve Lowe from NewsQuest, which publishes the York Press, the Northern Echo in my neck of the woods in the northeast, and various other titles. I've noticed the cover price of newspapers has risen quite considerably in quite a few cases over the last few months. But actually, advertising revenue, how is that doing? Are people actually pulling back on advertising, or are they trying to advertise themselves into better turnover and sales?
Afternoon, everyone. It's a bit of both, to be honest. What we found is demand for services is still very high. The motor trade, for example, has got a big order book of waiting for vehicles. The leisure sector is bouncing as people are coming out with disposable income. So we're finding that leisure is very active. So that's not particularly strong from an advertising perspective. And property, house prices are continue to keep going at some mad rate at the moment. I think it was another 10%. It was up this month compared to the same period last year. So there's quite a lot of demand from consumers out there. So what that does for advertising is it generates a bit of a yin and a yang. It becomes very competitive, and so you get some benefit from that. For us, as a business, our revenue performance is now catching back up with pre-pandemic for the first time in two years. But set against our costs are going through the roof. Our raw material costs, like everyone else's, are. So steadily improving would be my assessment of the situation. I think the thing for if you walk on the high street of particularly in York is it's never been busier in my time. The high street and tourism, and if you look at the hotel prices, are up quite dramatically on 2 years ago, and they're taking full advantage of people with disposable income. So people are spending, which is, I think, the positive of what we got at the moment.
And is your advertising moving more and more online, or is that?
100%. So yeah. So the two things go hand in hand. So typically in a regional publishing business like ours, 90% of our audience now is online. So the readers read our content online, and that's where the advertisers want to be. So whilst we still print newspapers every day, we print a fraction of what we did 20 years ago, and about 85 to 90% of all of our revenue is now being driven from an online perspective, from an advertising point of view. And the point you mentioned at the beginning is cover prices on newspapers have never been more expensive than they have been, and that's part of the revenue mix that we need to take to make sure that the printed newspapers can survive.
Yes, no, absolutely. Well, thanks for that, Steve. It's good to hear that York's busy. Kerry, we hear a lot about recruitment, and you're from Castle Recruitment. We hear a lot about that. We hear that there's a lot of vacancies out there, and just about every sector is struggling to get new staff on board. Is that actually genuinely what's happening within the recruitment sector?
Absolutely. I know for the last couple of these that we've been on, we've given very much the same message. There's still a huge mismatch between the amount of vacancies being registered across Castle and across the Yorkshire region, in line with the REC, which is our governing body report that I receive, that just doesn't match with the supply of skilled workers. It's slowed down this month, but I wouldn't say that. I'd say that that's more representative of the employers possibly deciding if they do need to hire the replacement, or if they're just seeing what happens with what might be lying ahead. But we're also seeing that pay pressure and the salaries that are being demanded are still way above anything that we've seen before. So with the candidates now demanding higher pay increases, and they're still not in line with inflation, so there's some challenges there. So people are possibly looking to move to an opportunity that might be paying more, because where they're staying and where they're working at isn't in line with inflation. So there is some movement, but still nowhere near the skills match. Lots of our clients are speaking to us about a strategy and a plan on sponsorship. So the really highly skilled areas, for example, design engineer. We're working with a number of clients that identified that there just isn't that demand and that skill set locally. They can't attract, so they're looking at ways of sponsoring to get the really highly skilled people in, and that's not something that they've looked at historically. So yeah, still a huge 500,000 people missing from the job market on the back of the COVID pandemic.
And you talked there about wages and salaries, but also is work-life balance and different schemes to help with that. Is that also something that prospective employees are looking at? I'm thinking particularly about Rob and Clive Owen, because I know they have been hugely innovative in some of the things they've brought on, both to help current employees, but also to attract new staff.
Yeah, I think it's a balance. I wouldn't say that it's one or the other is outweighing. So I think for it's personal circumstances and generational. Some people really want work-life balance because it matches back to what their personal circumstances are with childcare, or they've really got used to the home working, versus some of the new generations coming through desperately want to be back in the office, and their main number one motivator is money. So we're still seeing lots of movement for people that are, after the better salary and the better package than we are those that are looking for the flexible benefits. What we're saying to clients is offer and reflect on what your workforce is wanting, and look and ask them what they're after that'll make them stay from a retention point of view, and be as creative as possible. But it's not easy to say one size fits all, because I wouldn't agree with that.
Thanks, Kerry. Dr. Bob Gammy from York Business School. What are your thoughts? Are we heading straight into recession, or is it actually not as pessimistic as that?
It's a really interesting question based on what we've just heard from the other members of the panel today, and some of them giving really quite a pessimistic view, and others giving quite a positive view. And it's an incredibly confused situation at the moment, which makes predictions very, very difficult to make indeed. I mean, for example, from my own sector, we find that the university, the applications are up 50% this year compared to what it was last year. In the business school, up 67%. The biggest issue we have is we can't find accommodation for students. So we've got a huge demand for what we're offering here, but we can't find enough rooms for them to stay in the York and the wider York area as well. And it changed what Steve's saying. He's never seen York busier, etc., and Kerry about the employment situation. So alongside the negativity, there's lots of positivity. Therefore, making predictions about how things are going to go is is very difficult. What we've seen in previous situations is all the data points to one thing, so predictions are relatively straightforward to make. Here we've got the most confusing picture I think we've probably ever seen with the employment situation, unemployment going down, whilst we're getting all sorts of other things happening as well. So what we do know is inflation is high and it's going to get higher, and therefore that seems to be unequivocal and unarguable that will be the case, and it's what we do about that now going forward. I think is a really interesting question.
Oh, that's really interesting. And you mentioned there, interestingly, about finding accommodation. I'm just going to speak to Richard Peake now from the Helmsley Group. You're actually in property, Richard. How's property?
It's always a little difficult coming in at the last on these committee meetings, but to be fair, a completely mixed bag across the property sector at the moment. Residentially, we're still seeing very good demand across the whole board. There is certainly, as I've said in previous meetings, a pressure on build costs, and that's only getting higher at the moment, with transportation costs contributing significantly at the moment. But if you look at the papers, the house prices are forecast to rise 10 to 15%, dependent on where you are in the country at the moment. The average estate agent has 20 to 25 properties on the books, but probably 400 plus registered sort of inquiries. So there's certainly a demand there. Looking at York in particular, you're quite right, it is as busy as it's ever been. We are seeing good commercial lettings, good demand from our commercial occupiers, certainly across the leisure sector. Hotel operators very keen. And interestingly, what Bob was saying, there is undoubtedly a pent-up demand from the student side of things, which we are trying to work with both the university and the council to try and sort of deal with. So, where is it going to be in the next 3 to 6 months? I think there will be. I don't think there'll be a massive growth in terms of the house prices. So there may be a sort of a contraction of the margin there, which might make some schemes a little bit sort of less attractive for developers to look at. Commercially, it depends what sector you're in at the moment. Landlords are always keener to have occupied buildings than vacant buildings, obviously. So now we're through the worst of the pandemic, where a lot of landlords had to give rent concessions or reduced rents, holidays. Certainly on our portfolio, all the tenants that we worked with on that side are pretty much up to date with their repayment plans and are back onto it. We are, however, starting to see certain tenants who are coming to their end of their lease expiries, but who are keen to stay in occupation, having that difficult conversation with us as landlords in terms of what level of rent are we going to be expecting. There will inevitably need to be a sort of a drop in some rents because the market just isn't there to substantiate them. Frankly, I'm glad we work in York. It's a very buoyant city from that side of things. It weathered the storm better than some. I think it has some good positive prospects in terms of how it will go forward. But it's a very troubled waters out there at times.
Yeah, that's really interesting. Thank you, Richard. And I think what comes from quite a lot of people so far is that we're concentrating on the short term. And actually, the medium and long term, we just don't know because it is such a mixed, challenging bag. Rob Whitehead from our partners, Clive Owen LLP. What are your clients saying to you, Rob? Because you work obviously in a lot of different sectors, and also your own business's experience.
Yeah, well, I concur with everything that's been said so far. I mean, there's nothing unusual there that I've heard so far, but yeah, I mean, we're seeing businesses still very high demand for goods and services, and still, very buoyant in the business, but experiencing a lot of difficulties in terms of price increases, and supply chain issues are still there, and obviously staffing issues, a big problem. So, I've got one client where the turnover this year has gone up more than 30%, but that is all price increases. There's no actual volume in sales there. It's all price increases. That's just impacted on on the business. So supply chain very slow. That's causing a lot of planning ahead required, and obviously financing issues as well.
And do you see any particular sectors that are doing better or worse than others?
To be honest, most of our clients are doing well across the board. But it's really the the difficulty they're having is actually sourcing products or getting supply. The Ukraine situation's causing different markets to be affected. And there's widespread issues across there. But generally the clients we've got are, all sectors are doing well. Obviously things like haulage businesses are struggling with the increase in fuel prices, petrol and diesel things, but the market's accepting that those costs are rising, and they are increasing the prices accordingly. But it's just a chicken and egg situation of trying to keep the prices high as the material prices are increasing all the time. It's a challenge for businesses. And then on the consumer side, obviously, everyone's feeling the pinch with petrol increases. The cost of electricity and gas isn't fully hitting yet, and that'll come in the autumn. Food prices going up, so everybody's being affected. But I'm not seeing any downturn in business as yet.
Oh, thanks for that, Rob. I'm going to ask everybody to do a show of hands, and then we'll see if there's any dissenting voices. So I think I know the answer to this, but would anybody like to raise their hands to lower interest rates? No, that's what I thought. So what about keeping them as they are now? Dave and Kerry. So I'm taking that the rest of you are going for a rise, a small rise at the moment, incrementally. Yeah, very, very quickly. Gary, why a rise?
Because if we don't, and the US raises interest rates, the pound will fall and we will import more inflation because the pound will fall against the dollar. As simple as that.
Bob, your thoughts? Why did you vote?
I agree with that as well. I think inflation's out of control. We need to send the right message as well. We need to make sure that we do everything we possibly can to get it back into control. The only mechanism we really have for that at the moment is interest rates, so we need to put them up.
Rob?
Yeah, I think if we're following monetary policy, then we've got to raise interest rates, just as to check inflation. So no choice really.
Richard?
I totally agree. I think really it's a question of whether it's a quarter of a point or a half a point. And personally, I would probably just sort of bite the bullet, grass the nettle, and go hard quicker rather than just sort of delaying the inevitable.
Kerry, you don't want to raise interest rates this month?
Yeah, I guess probably not thinking at the same level as these guys are in terms of the bigger picture, just seeing the local squeeze with everybody already struggling with finances and what that might mean to individuals rather than the bigger picture.
Steve, you were for a rise?
Yeah, it's got to get inflation under control. That's as simple as that. It's getting worryingly high.
And Dave, you were actually not wanting to increase interest rates this month.
Yeah, I completely take on board what the guys are saying, but I just think that it is going to have a huge impact. I think there's so much borrowing out there that's been interest only led that I think even a 0.5% interest increase is going to have a big impact. So part of me is just thinking, we know that inflation is going to go up. We know cost of living is going to increase. I'm a bit more cautious, which is very rare for an insolvency practitioner, but I would be more likely to say, see how it goes for the next couple of months first, and then back end of the year, look at increasing it at that point. I think might just be a little bit too soon now. However, the last Bank of England discussion I was on, I know that they are talking about increasing it, certainly by October.
Well, that was a fascinating discussion. It wasn't all doom and gloom, thank goodness. It transpires that York is a thriving city, which is wonderful to hear. And we had a majority for a rise of interest rates to control inflation. So thank you to everybody for joining us today.